Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, be sure to hit subscribe and hit the notification bell so you can see future videos. But for today, let's answer the big question that's on everybody's mind. How do we prepare for the next recession? Alright, so I think first off we need to get one thing straight in terms of recessions and stock market crashes, and that is that they are bound to happen. Businesses go through cycles, stock markets go through cycles, things go up and down over time, and in the stock market especially those movements can be quite dramatic. So when we look at a lot of the indicators that are out there at the moment, there's a lot of things that are kind of flashing red lights and suggesting that we're probably towards the final end of a business cycle and that stock market valuations are quite high. So I've made a video on this in the past, but I'm just going to quickly throw up some of my thoughts and maybe some indicators you might want to look at that suggest that stock prices are really high at the moment. So I'll quickly jot those down. So the first one you want to have a look at is the Shiller PE, the Shiller PE ratio. Oh, Shiller. Essentially the Shiller PE ratio is a cyclically adjusted PE ratio that looks at the average earnings for the companies in a given index for the previous decade, and it adjusts those for inflation and different things like that. So the average Shiller PE ratio over the long term has been around 15. Currently we're at something like about 25, and I think it may even be a little bit higher than 25 at the moment. So per dollar of earnings over the last decade in the stock market, people are paying a lot more than they've traditionally paid for that dollar of earnings. So that's the first one. The second one is the Wilshire, I've probably misspelled that, but Wilshire 5000 to GDP ratio. So the Wilshire 5000 is essentially a collection of basically all of the publicly traded stocks on the US market. When you look at the combined market cap of all of those stocks, that's what we're talking about in the Wilshire 5000. So it's 5,000 companies that are publicly traded. It's essentially all the companies on the US stock market. And this is an indicator that's often called the Buffett indicator, the Warren Buffett indicator. Essentially, it compares the overall market price of those 5,000 companies to the GDP or the gross domestic product of the United States. So basically the entire revenue of the United States versus the entire market cap of the United States. And typically this ratio is, it's actually had a massive range over the last century or so. But when Warren Buffett was really buying stocks heavily in some of his early days, so in the 60s and 70s, this Wilshire 5000 to GDP ratio was something like about 40%. So the market cap of the Wilshire 5000 was about 40% of GDP. Over time that's gone up and down. It's got up as high as where we are today at 170%. But in the past, anytime it's gotten up to about 110 or 120%, the stock market's actually crashed. So things have gotten really expensive. We've had crashes and corrections. Valuations have come back down to more reasonable levels, and they're sitting right around that kind of 100% or slightly below ratio a lot of times. But at the moment, we are at a ridiculous 170%. So that metric is screaming overvalued. The only thing that is really kind of helping to justify some of these high valuations at the moment is basically really low interest rates. So there's not a lot of investments where you can generate a reasonable return at the moment outside of the stock market. When you look at bonds or interest rates on just a high interest savings account, best case scenario you're looking at probably 3% a year. If you run some numbers through compound interest calculators and those kinds of things on trying to reach retirement with a return of 3% a year, you're basically just not going to get there. So there's not a lot of alternative investments. Real estate prices are really high. It's not as easy as it was in 2008 or 2009 to find a property that's going to be cash flow positive straight away as a rental property, because real estate prices have gone up as well. So prices are very high. There's not a lot of alternative investments other than the stock market, and assuming you want to generate a high return. So valuations are really high, and always gravity will kind of bring these things down. As interest rates go up, that acts as gravity on the stock market. Valuation always kind of reverts back to a normal level over the long run. Valuation at the end of the day on companies is all dependent on how much cash those companies produce. At the moment, we're paying a lot for those cash flows. There's been periods of time where people aren't paying very much at all for those cash flows, but over the long term, the stock market is a weighing machine. It weighs up the cash flows of businesses and corrects to a kind of reasonable valuation for those cash flows. So that's kind of where we're at the moment. In terms of getting ready for the next recession or next stock market crash, I'm going to talk you through some strategies that I'm doing and that I think possibly you guys should be considering as well. So in times like these, from my perspective, there's two things that you really need to do to prepare and be ready to sort of take advantage of stock market crashes. So the first one is quite simple, and that's cash. So in order to buy stocks when prices are low, you need cash. Sounds very simple, but if you are really heavily invested at the moment, if you've got a large proportion of your savings and your net worth invested in the stock market currently, and things drop 50%, you're not going to have as much cash as you potentially could have to scoop up those shares at a low price. So when prices are high, as they are at the moment, the stock market's gone like this for about a decade. Up and to the right, it just kept going up for about a decade now. So there's been a lot of money invested over time. Prices have gone up. If you're still heavily invested, you're not going to have a lot of opportunity to put cash into investments when the market eventually goes like this. Pretty simple concept, but I think at high prices you should probably be selling, or at least considering selling a lot of your investments. Do some valuations on them, see whether those companies are overpriced relative to their value, and if they are, you should probably be considering selling out of those positions. So that's the first one, is cash. As Warren Buffett says, every 5 to 10 years when there's a recession and a crash, it rains gold, and you want to go out there with a washtub, not a thimble. If you don't know what a thimble is, Google it. I had to when I first heard that, to be honest. And a washtub represents basically a whole lot of cash. When it's raining gold, you want to catch as much of it as you can by putting a lot of cash into the market when prices are low relative to underlying company values and fundamentals. So that's the first one. Let's get into number two. So number two is a watch list. A watch list. So in times like these, when prices are high relative to underlying values, and you're probably not purchasing a lot of stocks if you're a value investor, it's a great time to do research and build a watch list. You're going to have a lot of patience in times like these, but you're also going to want to be ready to go and react quickly when prices come down and there's bargains out there in the market. So essentially what a watch list is it's a list of companies that meet your investing criteria. Forget about price relative to value at the moment. If companies are overpriced, they should still be on your watch list if they meet your other criteria. Prices are going to come down at some point, and we're going to get a chance to buy some of these companies. So you're going to want to be well researched on these, and you're going to want to have probably at least 5, ideally maybe 10 companies sitting on your watch list that you can pick up and buy. So in terms of criteria for me personally, this may vary for you, but hopefully there's a lot of similarities between the things you're looking for in companies as well. So the first thing, basically I'm going to go through the list of the 4 M's from Philtown, or at least the first 3 M's. So first we're going to have meaning. So this means a couple of things. Number one, do you understand the business, or at least are you capable of understanding the business with a little bit of research? Is it in your circle of competence? If it is, give it the green light. And the other one is, does this company actually mean something to you? Do you agree with what the company is out there doing in the world? If you're, a bit of a greenie and you don't like oil companies, for example, you're probably not going to have an oil company on your watch list. If you're like Phil Town's daughter Danielle and you love sort of whole unprocessed foods, natural foods, all that kind of stuff, you might have Chipotle Mexican Grill on your watch list. So do you kind of agree with what the company's doing out there in the world? Those are the kind of things that fall into meaning. So assuming it's got a meaning, we'll move on to the next M, which is moat. So the moat of a company is defined essentially as its competitive advantage in the marketplace. Is there a reason why that company has advantages over other companies who are potentially trying to do the same thing? Or is there something preventing those companies from, beating companies that do have large moats? So there's a few different types of moats. A classic one is a brand moat. So something like Coca-Cola. Coca-Cola has a brand moat. If the price of sugar goes up, they can charge more for Coca-Cola, and they're not necessarily as threatened competitively as name brand or as sort of less well-known colas. So you're going to be willing to pay more for a Coca-Cola product than Jim's Cola or Bob's Cola or Fred's Cola or some random brand that's sitting on the supermarket, because you know what you're going to get with Coca-Cola and you know it's going to be consistent. So what that allows Coke to do is have a long-term competitive advantage over those other brands. They can charge more for their products, and they're not going to be outcompeted over a quick period of time. They've spent literally over a century building the Coca-Cola brand, so they're not going anywhere. And that's a moat. So there's lots of different types of moats. You want to make sure your company has at least one. Just to run through some others quickly, there are secrets moats. So if the company has some sort of intellectual property that no other company can use, that would be a secrets moat. Drug companies are often an example of that. So if they've got patents on drugs that last a long period of time, that's a secrets moat. There's also a switching moat. So Apple is a great example of a switching moat. If you have an iPhone or a MacBook or anything like that, you'll know that it's going to be a massive pain if you were to switch to an Android product or something like that. To transfer your data across, transfer your contacts across, all that kind of stuff is going to be an absolute pain in the butt. So that's a switching moat. There's low cost producer. So that's especially important if you're buying sort of commodity companies. So if you're buying a company that produces milk or meat or metals or any kind of basic commodity where you don't particularly care where it comes from all that much, it's the same sort of product at the end of the day. Zinc is an element. It doesn't really matter where you get zinc from. It's not necessarily going to be massively different quality. So the moat that commodity producers can have is being the low cost producer. They have very low cost of production. If there's a downturn in the price of those commodities, they can still be profitable, where their competitors that have higher cost structures are not as profitable. They might be losing money, they may go out of business. Those are no moat companies that we don't want to deal with. We want to be in with the low cost producer if we're in a commodity type business. So those are types of moats I'm talking about. Anything that gives you a competitive advantage is a moat. So make sure companies on your watch list have a moat. And then the third one is probably the trickiest, to be honest, and that is management. So there's really two things you want to look at with management. Does the company management have integrity, and do they have skill? So do your research on these people. If a company is publicly traded, there's probably some sort of information out there around the CEO and the CFO and kind of those high profile managers. So Tim Cook is the CEO of Apple, for example. Elon Musk is the CEO of Tesla. Not that I would ever invest in Tesla at this early stage. You know, there's lots of very famous CEOs out there, lots of information on these people. So make sure you agree with who's running the company and you like the management and you trust the management as well. So there's sort of that personal integrity factor. There's also a skill factor. So are they actually running the business well? Are they producing high returns on your money? So the real key ratios you're probably going to want to look at there are ROE, return on equity, and ROIC, return on invested capital, or sometimes just called return on capital. So have a look at those. We want those ideally to be at least 10%, ideally 15 or 20%. Basically, it means that money that we've got invested in the business in terms of equity is going to be generating a high return consistently. It's very hard to get rich on a business that does not earn a high return on equity. So check that one out. And the other one is debt. So there's a few things you may want to look at for debt. Debt can kill a company, especially if you don't have a moat. So if you're in a commodity business and you're not the low-cost producer and you've got a lot of debt, you're putting your business at a lot of risk if you know, commodity prices come down. So check out debt levels, make sure that they're not excessive. Quick rule of thumb, you want to be able to pay debt levels off with about 3 years of free cash flow would be about the longest period that you want to look at for debt levels. Ideally zero debt. Zero debt's the perfect situation. A company like Facebook, off the top of my head, has no debt. I'm pretty sure Chipotle Mexican Grill has no debt, although I might be wrong there. There's companies with no debt. Those are fantastic, especially if they've got great moats and great management. So those are kind of the three things to do with getting companies on your watch list. Build a watch list of 5 to 10 great businesses, and when prices come down, hopefully you're going to have a chance to buy some of those businesses. So you want enough companies on your watch list so that when a correction does happen, enough of them come on sale. If you've only got 2 companies on your watch list, they may be great companies and they may do really well, but even if there's a big recession, if they're really fantastic companies, they may still not even come into your buy zone potentially. So you want about 5 to 10 just so you've got enough exposure to at least have a good number of those come on sale when there is a market downturn. And you want to jump in heavily, put the most money you can into your best ideas, and put a little bit more money into other businesses for some diversification. You obviously don't want to be stuck with just one business with all your money, because things do go wrong, things can and will go wrong. But ideally you want to put as much money as you can into your best ideas, while still having some sort of protection through a couple of other great businesses as well. So that's my thoughts on how to prepare for a recession and a stock market crash. I hope you enjoyed the video. If you did, give it a thumbs up, drop a comment and hit subscribe for future videos. Cheers.